Daniel, welcome back to Face. How are you?
Good. Can you hear me there?
Got you,
No.
Daniel. How are you?
Good. How about yourself?
Good. So, what's on the docket? I do eventually want to get to your the grains because we talked about them last time, and they did continue to decline, but they put on a nice little rally. I think they turned. I actually bought Tech ETF on wheat and
Oh, good.
about a week or so ago, and I know we're pulling back a little bit, but um, could this be the time now that the dollar is breaking down? Even though we're bouncing today, dollar under pressure, everyone wants a weaker dollar. What do you think, buddy?
Yeah, and I want to get to the grains, but I have a little bit to say on them. But after watching, the beginning of this face interview, hey everyone, I'm Dan Hussey. I'm a senior
Dan
market
Hussey.
strategist with Zaner Ag Hedge. I primarily specialize in helping commodity producers, whatever you might be producing, manage your risk in the futures market. But yeah, the dollar right now is a huge proponent of just about anyone in the commodity space, and certainly any currency traders and at the forefront of your trading plan. I have up here to kind of add to just jump and continue that discussion on the dollar and some of the correlations we've been seeing here across the futures market. And begin with one of the strongest correlations I have watched throughout my entire career, everyone. This is a chart of the US 10-year. Okay, and overlaid here and on the left side of this x-axis is the 6J overlaid with it. So we were just watching. Blake had, the S&P overlaid with it. This is
Yeah,
a currency, the dollar yen. If I
yeah.
were to change it to the
Yields.
Swiss franc, exactly. If I were to change it to the Swiss franc, it looks very similar. We've seen this extremely strong correlation for the last 10 years between currency markets and bond markets. It makes sense, folks, right? Yields have been changing and adjusting for the first time since the Great Recession in the United States, right? Since global interest rates bottomed out in 2008 through 2012, the period that we've seen the 12 years hereafter, well, now almost 15, I suppose, since the recession, we've seen effectively a rate rising environment. And during that process, the US dollar has had to kind of rebalance its valuation, right, on the global scene because of how those interest rates have moved around. And that correlation you see here between the dollar yen and the 10-year note has been a extremely strong correlation in, I mean, generally the history of both these
Yeah, look
contracts,
at that. Yeah. It
but
breaks
it's a
apart occasionally. You could get misled for
does.
a few weeks and, you know, but
Good
overall,
example. Good example
yeah,
to that right here back in October, when this is during a period where people were placing
yeah,
lots of bets, the interest rates, we were wondering if we're going to get a cut in December and this, that, and the other. Now here they seem to be very tight. I think that there's kind of a consensus in the trade, so to speak. And the reason I say a consensus in the trade is because of, I overheard you, Dale, that you might be short the dollar. Um, I think this Dixie chart we've been looking at together for
yeah,
almost every face interview, right? We've
yeah.
had a look at this. Everyone, this is a monthly chart of the dollar index, and I want to point out how far it moved from that Great Recession kind of low in value of
Yeah.
the dollar to its new high up here at 115. And these 5-year periods of, oh, I would say, 15, 20 point ranges we've been caught up in. The major question we have right now is this breakdown below this trend
Yeah.
line support, right? Is this enough of a break to say, hey, we're going to test this low and start, another trend lower? Because you break this
Yeah.
15 to 20 point range, you're back into the old 5-year range for the dollar, and you could unwind back down to that 200 month and the old lows around 90. You
Nice
just
luck,
go
Daniel. I like it.
just back just back to where from where you came, right?
Yeah.
In the very short term, we are hitting that 18-day moving average. A little bit of a
Yeah.
reversal pattern from Friday, but we are
Yeah.
caught in what I would call pennant, a flag,
I'm
a
waiting
bear
for
flag.
your line, your orange line. Look at there's confluence at 102.50 if you go to where we are now. That's where I'm a seller. And then I mean if
Absolutely.
we start closing over 104, I'll reassess.
Yeah, and there's a lot of reasons I'm sure, Dale, you're picking that level. We obviously see the upward
Yeah,
sloping trend line that broke. A little,
yeah.
I don't know who coined this term, but the kiss your mother, old support, broken, now being tested as resistance before continuing your lower. It runs
Yeah.
out the door, comes back to kiss your mom goodbye, and then heads lower.
Oh, how
The
sweet. I wish I still could do that. If you guys still have your moms, you need to do that today. That's a great
Yeah.
reminder and if she's far away, you could throw her a kiss over the phone.
And this 102 level, very important. It was originally a gap that started our year off with some bullish dollar activity. We've
Yeah,
unwound the start of that year. We took out basically the lows of the year, the gap up, and now we're, flagging below that level. That's not great for just price action if you look at this year in a vacuum, right? Then if you take a step back and you look at price action of the last few years, well, now you see we're testing
yeah,
major levels that if we break, this is very much my opinion, and humbly speaking, the start of a downtrend. So
yeah.
Dale is waiting for that rally up to sell into that 102 area. Also equal legs up. Like you said, a lot of confluence there. I can't disagree with that type of idea. I also, being a momentum trader, I'm looking for that break below 100, to become
Okay.
a net seller for that continuation lower because back below 100, kind of just a big psychological figure for the Dixie.
Oh, that'd
Opens
be a
the
big
door.
breakdown. So I'm looking
Right.
for 97 on the next decline from 102.50.
Sure, and that would put you solidly below the
Right.
lows of 2023. That would be a big signal to this market. The monthly, the dailies, every
Yeah.
single market, chart would be making a new major low, and you'd be undeniably having to talk
So
about the trend line.
you could make a big case, Daniel. What do you think of this? The high at 114, call it a 1400 point decline with sideways consolidation, corrective action, and a breakdown under 100 gives you 86, 14
Yeah,
minus
I
100.
I can see, right? You got that decline down, your
Yeah,
sideways price action, and then most technical traders start immediately thinking in our heads, right? Well, this distance
yeah,
down, project it lower, and it takes you
yeah,
right down into that, 80 that 86 area. And certainly when you go back and look at the long-term time frame targets, it takes you right down, or the long-term chart, that takes you right down into the old supportive lows from
yeah.
2018 through 2020, the pre-COVID support for the dollar that then,
Oh, yeah. Interesting.
ultimately ran up. So,
Okay.
the levels that we're seeing in terms of projections for potential downside targets aligning with those big supportive levels. And that's all a trader can do, right, to try to develop a plan.
Well, you need a big bear market to get people to say, okay, I'll take the CBDC.
Yeah, certainly.
You ever think of that? I'm Mr. Conspiracy here on Face, but
Well,
anyway, why would people give up the dollar unless there's a dollar crisis?
certainly, right? And any, inflationary pressures, lots of different reasons. It can happen very quickly and it can happen slowly over a long time, right? As
Yeah,
we
yeah,
either lose faith in the currency and its purchasing power or look for alternative means for stores of value. I mean, it's a
yeah,
tale as old as time though, Dale. This has happened as long as fiat currency has been in existence. And anytime a government takes an asset and creates it into a currency, it becomes fiat. They're even in ancient Rome, gold was debased by cutting it with other metals.
yeah,
We like to think that there were standards, but there really haven't been. Anytime governments take money and create a financial monetary system from it, it gets debased, it gets
yeah,
devalued, inflation happens, and
yeah,
you just have to realize that on a long enough time frame, those things have to be accounted for. And unfortunately, we've never seen a currency on a long and from its existence until now, uh, you know,
yeah.
it,
So,
it
so
survive, right?
is
They eventually fail, unfortunately.
so
They
is this
all
going to
have.
be the catalyst that the grains need that we start to become a more attractive um, spot to buy stuff because the dollar's getting cheaper?
And that's a great segue, right, into the commodity space, into the grains in particular, because grains alongside maybe gold are one of those assets that have actually been internationally traded since the dawn of civilization. We don't talk about grains that much, but they are kind of an international currency, and they rely heavily, at least our export market being in the United States, a very large producing breadbasket for the world. we have to export a lot of our grain to the rest of the world. And the US dollar transacts just like any other commodity and just like any other currency transaction, right? There's a
Yeah.
swap for dollars that occurs. And if dollars are too expensive to source, our export partners don't necessarily like to buy our commodities if they don't have dollars on hand already, which some of them, like China, do. That's a whole nother discussion. But
Yeah, that's
um,
a political thing. That's another thing. China hasn't been buying U.S. grains, right, Daniel? They've been going to South America for their
that's correct.
purchases. Okay.
And
So let me
and
tell you, I don't care how things are politically between the U.S. and China. If the price is right, China will buy U.S. grain.
And that's the big $1 million question we're asking ourselves. And we are, folks, seeing some daily, what we refer to as flash sales. The USDA requires reporting of exports of over 100,000 metric tons on any given day be reported in a daily flash sale, effectively notice to the USDA, which then they publicly announce to the world that, hey, we have booked this in terms of an export. That happens daily. So those numbers come out in real time. Everybody looks at 8 a.m., 9 a.m. Central to see that USDA announcement, to see if countries like Mexico are still buying our corn, Japan is still buying corn. That we want to see China buying soybeans, soy meal, corn. When those things happen, we know that that export market's working, and it's a clue. It's a clue that maybe price, and I have a chart up here of December daily continuation chart for corn going all the way back to 2008. You can see this daily upward sloping trend line on the lower bounds of the chart. Um, Real quick, I personally define inflation not by the peaks that the market hits, but how low the trough in the market doesn't go out. In other words, inflation's a rising tide, and these are the waves crashing on the beach. That rising tide might go a little bit higher every time, but it never quite goes out as far as it used to. And that, in my opinion, is the better measure for that rising tide of inflation. And if you look at things like row
Nice
crops,
metaphor. Yeah,
you can see going back to the 70s, this slow rising tide of inflation that etches markets like corn a little bit higher every decade. And
yeah,
that's the main, ride that we need to remember happened and has now effectively unwound. And countries like China that are buying these products hand over fist because they can't produce enough of them to feed to their 1 billion person populations. There's also other countries like India now that are coming online to being net importers of grain. That is in my opinion, the single biggest news story of 2024 that no one's talking about is that India is importing grain from the rest of the world for the first time uh, on record. And they are probably going past this point of no return of self-sustainability in terms of population to agricultural production. So we have another nation of a billion plus people that is becoming reliant on net import for food products, making maybe these low prices for grain that, hey, we were at $8 of corn just 2 years ago. We're at under half that right now, making these prices maybe very attractive. And when you look at the long-term upward sloping trend lines, you start to realize this market really did have a period of not only hot, dry weather that caused a supply crunch in grain markets, but we also had an international
yeah.
inflationary move. And then
And
we've
we
had basically
Ukraine.
2 years of, correct, Ukraine, the wars. I mean, just every headline, right? I mean, every headline since
You know,
2020 has
Daniel,
been insane.
where Ukraine went into Kurtz, that's Russia's breadbasket. So
Yes, and
both,
you can almost look at the wheat market and time some of those,
yeah,
military actions on that chart.
yeah. So even bear market rallies are, even if we don't go back to $8, what a great trade from 4 to 6.
Absolutely. And six may be a little unattainable and like just for December corn, but the idea being is that we have really taken the wind out of the sails. We had a few years of pretty good production. We had a couple years of China going and looking at Brazil's production more so than the United States. And so we're left with lower prices. But like you said, Dale, it doesn't matter what the politics are. China's going to do what's right for China. And when prices are this low and the dollar is perhaps starting to decline as well, right?
Yeah, it's a deal.
These two things become a deal, right? If the dollar's
Yeah,
going lower and grain prices are low and they need to source grain prices, this becomes a deal for them. So
Yeah.
we are anticipating, and maybe some of this buying over the last week has been that uptick in export pressures. It's also been if you look at commitments of traders, folks, in the futures, both corn and beans have gotten record short from the fund or the speculative category. In other words, those guys that don't take delivery of corn.
Yeah.
When
How
the
about
December
commercials?
commercials are very long, and as they should be,
Okay.
because these are great prices, right?
Yeah.
They'll own it down here. They need it.
Yeah.
But this, what you referred to as potential short covering bear market rally that we've seen in corn and beans, and I'll bring up a chart of November beans here. You can see that similar move back up above the 18-day, reversing back towards. I don't want the nearest. I just want daily. There we go. Back towards the 55-day moving averages. Very technical reversal and move, and short covering rally, but it
It broke the
hasn't been.
downtrend.
It
Draw a trend line from those highs at say $5, and
it absolutely
just
did. We had a
broke it.
very, very clear channel here. Why isn't my drawing working?
There you go.
And that channel was, I defined it by the 18-day moving average. But
Yeah.
many times, Dale, as you pointed out, that trend line, it's effectively the same technical level people are
Right.
watching.
It is.
Same idea. You break above it, you head back towards that $10 mark, which is a psychological level for soybeans. We broke above that. We spent a couple days consolidating above. And now the $1 million question is, does it have the ability to continue this short cover, get back above this 1030 area, which was the support that we broke below from July, and continue the short cover back, towards, $11, towards that 100-day and 200-day moving average.
Galaxy just made an interesting comment. With all this, the bear move in grains up until it still could be a bear market, but
And now I
the
can see
fact
the
that
chat. There we go.
the grocery prices haven't reflected the decline in grain prices. Can you imagine if we have a bull market in grains, what's going to happen at the grocery store?
Um,
If they didn't come down, the prices didn't come down during bear markets in grains.
Yeah, and people say greedflation all the time, but the truth is, you guys weren't paying the real prices that it costs to produce these things when we were at $8 corn either. If you were paying those
Oh, okay.
prices, you couldn't have afforded cereal. So the production supply chain for human consumption on grains is completely different than the charts we're looking at now. This corn
Oh,
chart, not a grain of the corn I'm looking at right now goes to human usage. And that's one big
okay.
difference of what we're looking at here. This corn that we're looking at goes into ethanol and food
Animals.
stuff, not eaten by humans at all. White corn and wheat and oats, different products, definitely saw run-ups, but they were completely different. Now, wheat's an interesting product in and of itself, but but to your point, I think an even better example that really hits everyone's pocketbooks is crude oil and gasoline prices. Crude oil went up to 120. We're at half of that price valuation on the board of crude right now, and gasoline prices aren't half what they were, a year ago or what have you. So
Yeah.
yeah, that's where that change in spreads in terms of market and productions goes. People have to
Well,
realize, though, that the cost that you are paying is also reflective of increased wages of everyone to produce it,
there you
increased
go.
wages of everyone to move it to you, because it's not being grown in your backyard. It's had to travel thousands of miles to get to your grocery store, and the wages of all the people who have to sell it to you as well. Then you've also got the increase in cost to move it from point A to point B. Shipping costs are at multiples of what they were pre-pandemic. So while the raw commodity prices are down, the labor and cost of production is bigger than it's ever been. So you say greedflation, I say that's the cost of doing business and paying now the higher labor wages that we have to. And
I
that's
I say up
the
like a
economics of
rocket.
it.
I say up like a rocket ship, down on a parachute. That's what
Yes,
happens to wholesale prices. They
and
go up
margins
like
and
a rocket.
profits. Yep.
Yeah.
And margins and profits will get bigger for companies as they adjust to that. And now they will get much tighter as these commodities get bought up at low prices and they can no longer source them. It's interesting, right? The answer for high prices and low supplies
High
is low
prices.
prices and high supplies, right? And now
Yeah.
the answer for low prices and high supply will be those companies becoming their worst enemies and now inflation taking back over, right? Them putting that money back to work, gobbling these prices up, competing. Wages should also continue to go up because wages haven't outpaced that. So the working man and everybody out there needs to continue to fight for, to try to make more money because there's profits and margins to be able to pay you, is the moral of the story. So,
Did you
yeah.
get a raise this year?
Me, unfortunately, I'm 100% commissioned.
Yeah,
So
I know. We have to give
and
ourselves, right?
ironically, and ironically, my commissions haven't changed in 30 years. We joke in the futures market how
Uh,
we're the only guys who
yeah,
our commissions have
yeah,
been the opposite of inflation. They've only ever
yeah.
gone down.
Yeah,
Um,
isn't it? It's a anyway. So, can we wrap it with your view on the violent action we're getting in equities?
yeah, I think, the violent action we've seen in equities is certainly, I think there's a little bit of end of month, quarter, summer kind of ideology here, right? We just came out of the Fed Jackson Hole meeting. That's always a really big time for them. I was looking over that S&P 500, just the cash chart here, because I was thinking, what to the downside have we missed? Have we sped through? Are there levels that the market, okay, you look back and now you can play the 2020 hindsight game. Gap
Yeah,
up here,
5,400.
middle of,
Yeah,
right?
yeah,
There's a gap here. There's a little bit of a gap here at 53.52. You look a little further back. There's still an open gap from around 50.66. I'm not a big gap trader. I'm just thinking to myself, hey, gaps like to fill. The market arguably there's a bit of a double top-ish type feel to it up here at 56.50, right? The failure to get and break out with all of this strength and new contract highs and making new all-time highs, I should say, and being met with now some pullback, reflective of profit taking, the failure of that momentum. There's all the things you can say, but we seem to be now wanting to set up into a much larger, maybe trading range for equity indices. I think the
hmm
break in the dollar and certainly gold's inability to break out too might have, kind of generated a larger risk swap or move here. But there's more money being moved around on hedge fund balance sheets than like ever before in history. So the liquidity that's out there is huge, and the lot sizes that traders are trading is huge. And I point that out because this could very well have just been a few hedge funds wanting to take profit in this environment, and nothing more than a couple day pullback that should be bought, into a 50% retracement. Um, that's what this type of pullback can be in this environment. We almost have to adjust ourselves and realize that a 200-point drop in the S&P, it's what a 40-point drop used to be,
hmm
and that's something I'm still trying to adjust because I'm used to the days, you know, 20 years ago when the market, well, maybe not this far back, but the last time we had moves of this caliber into the 80s and coming into the early 90s, we were breaking out above 400, 500. And I just want to remind everybody that how quickly a market can turn from looking like, oh, it's going to roll over and be very bearish
yeah.
back in 1994, at that time, 40-point drop in the S&P. That's a 10% drop in the market from 480 down to 440. And then over the
Boom.
next year exploded, doubled in value, like it
Yeah.
was nothing. I'm not saying that that is exactly what's going to happen here, but boy, over the last couple of years, we've seen those types of moves in the market. We've seen consolidation that broke out, tests of support, breakouts again. I mean, every major move on the monthly chart seems to want to be bought up. Um, and my point of saying all of this is that, hey, we're starting to creep above old targets that we had talked about maybe previously too, but we're kind of consolidating in what could be a larger range. And in the very short term, this failure, I think, could be and this rollover could be very interest rate related. There's lots of talks. We've looked at the correlations there. There's a lot of financial policy that's being swung around. And it's interesting that this market kind of takes a turn right after the Federal Reserve goes to their Jackson Hole meeting. I don't want to say put the tinfoil hat and conspiracy theorists on, but it seems like the guys that make a lot of decisions made some decisions about what they want for the market over the next, near term, and that might be playing out is kind of what I'm getting at. So
Okay.
technically speaking, I think there's some support down here around 5,300 on the S&P. That's the old highs that we, have chewed through, broken above, came down and, maybe arguably trapped some liquidity below, but have gotten back above. I am Still bullish the S&P on the daily and monthly time frame above 5,300 for the time being. But I do think we're probably going to consolidate in, a range, or maybe have a period kind of like this, that we had in 2022, where, an uptrend, very pronounced uptrend occurred, a reversal and a failure to, kind of break out began. In this case, it was I want to say a stop hunt, or a failed top, but
Yeah.
a little bit of a blow off top there and reversal, and then set up in consolidation for a period. There's nothing wrong with the market doing that after, effectively doubling in value, right? Go back to 2023, we're trading below 4,000, we're trading above 5,600 here recently. This market's done a lot of work. Pullbacks happen, and a healthy consolidation here isn't out of the question.
All right, man. Nice, very nice interview, Daniel. Thank you very
Well,
much.
everybody, thank you for having me, as always.
Zaner's a good firm. Daniel's a good broker. If you want to find a broker and have full service for commodities and other things, and Daniel does full service. So hard to
Absolutely.
find nowadays. And usually you're just on your own with your mouse. But if you delve into areas that are outside of your realm of expertise, you need a partner. So
Absolutely.
Daniel, I appreciate your work. I always learn something from you when you're here, and appreciate you coming every quarter to tell us what you're seeing.
Love being here. Thanks for having me, everybody. You can always get in touch with me. You see my number scrolling there on the screen. We'll have Dale. You guys know where to find me on Twitter and everywhere else. You should all know me by now. But thanks for
There it
having
is.
me, everyone. Yeah, we will. Until next time.
We'll talk on the other side of the election.
Yeah. Have a good one, everybody.
All right, Daniel Hussey Jr., everybody. Follow him. Guy's been around, okay? He looks young, but he's really 75. And anyway, you can take the emotion out of the market. Yes, you can. And people are thanking you, Daniel. Thank you. I'll thank you too, my trading warrior brother. And everyone, you could join the team in 15 minutes for the morning edge. And if you're not able to do that, you know what you need to do to get in there. And don't just count your pips, count your blessings.
Hey traders, this is Blake Morrow with Forex Analytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.